Applications of the dividend discount model. The dividend discount model is a general model that describes the intrinsic value of a common stock as a present value of all future dividends in a perpetual dividend stream. It presupposes no particular pattern in the stream of dividends, but its popular practical application is in valuing common stocks with dividend streams that conform in whole or in part to perpetuities. And so we have three special situations in which the dividend discount model has the greatest practical application: valuing no-growth firms, constant growth firms, and differential growth firms. The dividend discount model envisions a perpetual stream of dividends, and so the model has a particular application in dividend streams that can be valued as perpetuities. In the case of a no-growth firm that pays a regular dividend of a constant fixed amount, the dividend discount model takes the form of a level perpetuity. For a no-growth firm, its stock price is equal to the fixed dividend divided by the stock's opportunity cost of capital. The second situation is a case of a constant growth firm, in which the regular dividends are growing at a constant growth rate, G. And so the dividend discount model takes the form of a growing perpetuity. So in the case of a constant growth firm, its stock price is equal to the dividend expected next period divided by the appropriate discount rate minus the constant growth rate in the dividend stream. In the second formula box, we're given the current dividend, which has grown one period at G to get the expected dividend next period. This formulation of the dividend discount model is called the Gordon growth model, named after Myron Gordon, who introduced the model in a 1959 paper. This is the most popular and useful formulation of the dividend discount model. The current dividend paid to the common stockholders of XYZ Corporation is $2.25 per share. Dividends are expected to grow at an annual rate of 8%. The market requires a rate of return of 16% on XYZ common stock. What is the stock's current price? We recognize that XYZ Corporation's dividend stream conforms to a Gordon growth model. We're given a current dividend of $2.25. We need next year's dividend. So we grow it out 1 year by multiplying it by 1 plus R, the 8% constant growth rate. We divide next year's dividend by the required return minus the growth rate, 16% minus 8%. And we get a value for the stock of 30.375, or 30 3/8. Valuation is very sensitive to the growth rate estimation. In fact, stock price is a bet on future growth. And the expected dividend growth rate is a problematic estimation. We can estimate the constant growth rate by looking at recent historical growth in dividends. But when you use historical data, you're assuming the future is going to be exactly like the past, and that may not always be the case. However, looking at past dividends does give you insight into the firm's preferences with respect to its dividend policy, and these preferences can carry into the future. In general, managers are reluctant to cut dividends, and they're reluctant to make changes in dividends that may have to be reversed in the future. Managers consider previous dividends when setting the current dividend. They try to maintain a steady dividend, and they'll set current dividends consistent with a long-run dividend payout ratio. We might also estimate the constant growth rate by using analyst estimates of the growth in earnings. Financial analysts provide forecasts for the expected growth in earnings for the next 5 years. This forecast may give an indication of the expected long-term growth path of earnings. And assuming the firm has a long-term payout target, we can use earnings growth as a proxy for dividend growth. We might also estimate the constant growth rate in dividends by calculating the sustainable growth rate for earnings. Sustainable growth is a growth that can be maintained solely through financing investments with retained earnings. If the firm has a long-term payout target, this is the growth that can be sustained over time by the firm. And let's look at how this is calculated. The growth in earnings for the period G is equal to the retention ratio times return on equity. The retention ratio is the proportion of total earnings that are retained in the firm and reinvested. Retained earnings are equity investments in the firm and are expected to earn the return on equity. And recall that a portion of earnings can be paid out as dividends and a portion of earnings can be retained in the firm. So the retention ratio can also be calculated as 1 minus the dividend payout ratio. Now let's derive G, the growth in earnings for the period. Given the period's initial earnings, E0, and the earnings at the end of the period, E1. Earnings at the end of the period is equal to the initial earnings plus the retained earnings times return on equity. And this is the return earned on the retained earnings over the period. The end of period earnings can be restated as the initial earnings times 1 plus G, as the earnings over the period grew by G%. We solve for G, so let's divide both sides by the initial earnings. The initial earnings cancel on the left-hand side. Initial earnings over initial earnings is equal to 1. And this is the retention ratio. So we get this expression. To solve for G, we subtract 1 from both sides. And we get the growth of earnings for the period is equal to the retention ratio times the return on equity. A.E. Newman Enterprises just reported earnings of $2 million. It plans to retain 40% of its earnings. The historic return on equity, ROE, is 16%, a figure expected to continue into the future. How much will earnings grow over the year? We solve for G. The retention ratio is 40%. Return on equity, 16%. Earnings will grow 6.4% over the year. Solving for the required rate of return. There are 4 variables in the Gordon growth model. Knowing 3, we could solve for the 4th. So let's solve the equation for the rate of return. The resulting equation tells us that the return on common stock has 2 component parts: the dividend yield and the dividend growth rate. Previously, we established that the period return on common stock was determined by the cash dividend and the capital gain. So yes, the return on common stock has 2 component parts: the dividend yield and the capital gain yield. So G in the first equation must be the capital gain yield, which implies that G is not only the dividend growth rate, but is also the stock price growth rate, and therefore the growth rate in the investment. The current dividend paid to the common shareholders of XYZ Corporation is $2.25 per share. Dividends are expected to grow at an annual rate of 4%. The stock's current price is 30 3/8. What is the market required rate of return on XYZ common stock? We're given the current dividend, $2.25, but we need next year's dividend. So we grow the current dividend out 1 year by multiplying it by 1 plus G, the 8% dividend growth rate. We divide next year's dividend by the current price, 30 3/8, to get the expected dividend yield. To the dividend yield, we add G, the dividend growth rate, 8%. And we obtain the required return, 16%. The main strength of Gordon Growth Model is that the valuation calculations are easily performed using readily available or easily estimated inputs. The Gordon Growth Model works best for firms with strong and stable earnings, with high dividend payout, and with stable leverage. Let's consider industries whose firms might be good candidates for valuation using the Gordon Growth Model. Regulated companies such as public utilities are good candidates because their growth rate is constrained by geography and population to be close to the growth rate in the economy in which they operate. They historically pay high dividends, and they have stable leverage. Large financial service firms are good candidates because their size makes it unlikely that they will generate extraordinary growth, and they pay large dividends. And they generally don't have much leeway in changing leverage. And real estate investment trusts are good candidates because they have to pay 95% of their earnings as dividends, and as they are constrained in terms of investment policy, they can't grow at high rates. Let's use the Gordon Growth Model to value the stock of a likely candidate, Consolidated Edison. Consolidated Edison is a holding company which owns Consolidated Edison of New York, a public utility which delivers electricity and natural gas to customers in the New York City area. The rationale for using the Gordon Growth Model to value Consolidated Edison. The firm is in stable growth based on the size and area it serves. Its rates are also regulated, which tends to stabilize them over time. The firm's leverage is also stable, and it has a high dividend payout. Its payout ratio averaged 75% over the last 4 years. Now let's get some data for the firm, and we'll find the data on financeyahoo.com. I'm on the home page of Yahoo Finance. We want data for Consolidated Edison, and its ticker symbol is ED. Its most recent price, $64.66, and that was on Friday, August 3rd, 2012. Let's look at the trading range. Over the day, it traded between $64 and $65.04. Over the past 52 weeks, it traded between $49.18 and $65.98. Its current annual dividend is $2.42. Its dividend yield, 3.7%. Beta is the risk of a common stock relative to the risk of the market as a whole. A stock with a beta of 1 has the same risk as the market. Consolidated Edison's beta is less than 1, so its stock is less risky than the market as a whole. We want analyst estimates of the growth in earnings. So let's scroll down, and we find analysts. And let's click on estimates. We want the analyst estimates for the 5-year growth in earnings. So let's scroll down. And we have growth estimates. Next 5 years, 3.07%. Alright, we have some information. Now let's do some calculations. We collected our data. The current price of Consolidated Edison's common stock was $64.66. Its current annual dividend, $2.42. The analyst's estimate of the 4-year growth in earnings, 3.07%, and we'll use this as a proxy for the dividend growth rate. We need a market rate of return, and I estimated a return of 7.1%. Recall that the required rate of return is equal to the risk-free rate plus a risk premium, and I use this model to estimate our rate of return. For the risk-free rate, I use the yield to maturity on a 10-year U.S. Treasury bond, 1.6%. The historic risk premium for the market has averaged between 5.5 and 8%. As Consolidated Edison is less risky than the market in general, I use a lower market risk premium as a proxy for the risk premium for Consolidated Edison's common stock. From the model, my estimate of the required return is 7.1%. We have our inputs for the Gordon growth model. We have the current dividend, $2.42, but we need next year's dividend. So the current dividend has grown 1 year at 3.07%. We divide next year's dividend by the required return minus the dividend growth rate. 7.1% minus 3.07%. We get a price for Consolidated Edison's common stock of $61.89. We didn't do too bad. Our estimate compares favorably with Consolidated Edison's most recent price, and it's within the stock's trading range. Our third special situation is a case of a differential growth rate firm. In this case, a firm has experienced a period of higher growth in earnings and dividends. But at some point in the future, the high growth subsides, and growth is now at a lower but sustainable rate which is expected to persist into the future. We can value the dividend stream in this later growth period as a delayed perpetuity. We use what is called a multi-stage dividend discount model, which just means we estimate the firm's stock in 2 stages. We find the present value of the dividends during the period of initial growth. Then we find the price of the stock at the end of the initial growth period and discount this price back to the present, and add these 2 components to find the stock's price. Let's look at an example problem. XYZ Corporation will pay a dividend this year of $2 per share. Dividends are expected to grow at a rate of 8% for the next 4 years and 4% thereafter. The stock's cost of capital is 15%. What is the price of the stock? We first forecasted dividends over the initial growth phase. The first dividend is $2, and dividends are growing at 8% through year 4. We discount each of those dividends back to the present at 15% and sum the present values to get a total present value of $6.35. We now value the dividend stream subsequent to year 4 by calculating the year 4 present value of that dividend stream. That dividend stream conforms to a constant growth perpetuity, and we use the Gordon growth model to find its cash equivalent value at the end of year 4. The forecasted dividend in year 4 was $2.52, but we need the dividend in year 5, and so we grow the year 4 dividend 1 year at the new growth rate of 4%, and then we divide the year 5 dividend by the 15% cost of capital minus a 4% growth rate in the dividend stream. The cash flow equivalent value of the perpetuity at time 4 is $23.83. The $23.83 is the terminal value of the common stock in year 4. We discount that year 4 terminal value back to the present at 15% for 4 years. Its present value is $13.63. We add the present value of the dividend stream component parts to determine the stock price. $6.35 plus $13.63 gives us a price for the common stock of $19.98.